Target just issued a shocking warning that could spell disaster for America. What's coming next will terrify you. I'm your host, Steve Metre, and thanks for joining me today. And our show today is not just about Target, because this is going to impact every major retailer and a small business across the country. It's about the future of our economy. Their warning will leave you stunned. But before we get to that, we have the shocking economic signal that came out today that was buried by the mainstream media, and the signs are undeniable. The fallout could be catastrophic. And wait till you see the government's response to this, because 2 days ago they came out to front run it, and you're not going to believe what they had to say. Now, let's pick this story up with a headline. As initial jobless claims hit 3-year high, despite a survey saying there's going to be a huge surge in post-election hiring. On a non-seasonally adjusted basis, jobless claims exploded higher in the second week of January, now to 351,000. Remember, last week we talked about how continued unemployment claims on a non-seasonally adjusted basis jumped over 300,000, and yet the mainstream media did not pick this story up. Instead, they didn't even talk about it at all, as they focused on the headline number, and that said initial claims only rose on a seasonally adjusted basis to a low 217,000. Meanwhile, on a non-seasonally adjusted basis, here you can see up 351,000 from last week, that printed in at 306,000. And this is a dangerous trend, my friends. But is it unusual this time of year? Well, it isn't. The problem is what's underneath that data, and wait till you see. Because when we go back in history to right around December, what do we see? Initial jobless claims on a non-seasonally adjusted basis, shown in blue, spike going into January, and then they come down. Hence why the government seasonally adjusts this in the way that they do. The problem is when you factor what's going on in continued claims, well, we get a completely different picture. But continued claims dip from 1.877 million to 1.859 million. This according to the government. But check this out. On a non-seasonally adjusted basis, after jumping over 300,000 last week, they went up over 93,000 now to 2.28 million Americans on unemployment. So what we have an issue here is seasonal workers are coming off of the employment line. The problem is when we look at the data, the opportunities for them to re-enter the workforce are not there. That's why we're seeing this continued increase in continued unemployment claims, and notably the mainstream media completely overlooked this. But what this means is Americans around the country are going to be looking to make extra money, and it couldn't be any easier. Check this out. Let's update on this trade. This is actually as of yesterday's data. This is a trade that I'm personally invested in. Yes, I trade my own reports. Look at this. This trade we took on at the end of December is up over 7% relative to the S&P 500. The same trade came to Momentum Time Pro subscribers a couple of days earlier. It's got a 6% lead over the market. Now, what do we do? How do we do this? How do you make money in the markets? Well, we run 2 reports every day. One looks at machine positioning. What we're doing is looking for when machines are in a deep short position or the market's moving against them and they need to come in and buy. And we position our subscribers to buy ahead of the machines and get out before they sell. Our other report looks at changes in momentum, but we run a proprietary overlay that smooths out the signals and gives us the edge. We give you all the notes with our reports. We tell you what to trade, when to trade it, and you get the daily reports, the tradable signals, my opinion on the best trades. We back test our reports so we know all our signals are good. We've got stop loss levels to help you control your risk. We update our trades each and every week. And not only can you follow along with what I'm trading, you can grab our 30-day free trial while supplies last, because there's going to be a huge surge in people falling out of the workforce. Because look at this, we see small business hiring plans in green, and what they said after the election, there's going to be a surge in hiring. And in turn, what do we see on the non-seasonally adjusted basis? The exact opposite. We see many Americans losing their jobs, looking to create extra income. You want to do that, hit those links in the description below, because wait until you see the response the government had. And 2 days earlier, the St. Louis Fed, well, they were ready. And it said our initial jobless claims a useful gauge of labor market conditions, trying to set up the fact that we don't care if initial claims go up, because you can get the impression that they're trying to tell you it doesn't actually matter. But it does matter in a big way, because what we're seeing from central bank officials now is they're getting worried about the economy. And their study examined whether there exists a threshold of initial claims that exceeds a turning point in labor market conditions, suggesting that is it okay that they go up in the short term, or is it a sign that something's worse to come? Well, they didn't look at the complete picture, and the complete picture is when you find out that if initial claims and continued claims are rising, what it means is those going on unemployment don't have an opportunity to get back in the workforce. And what they found is claims rising above a certain signal indicates weakening conditions, while claims falling below a certain signal involved improving conditions. And the rule of thumb threshold commonly used by business economists was 400,000, meaning we're below that. The problem with initial claims, as you now see on a seasonally adjusted basis, it was rising over the last 2 weeks now. If it starts to get near that 400,000 print, we're in trouble. Well, that is until we actually look at the data, because when we look at this chart, and I understand it's hard to see, that the St. Louis Fed looked at the realized initial jobless claims relative to the optimal threshold. And the optimal threshold is in red, and across the horizon there's a very faint gray dotted line. So what we see here is the optimal threshold is actually below 400,000, and now that we look at initial claims pushing 350, potentially risking going higher as the economy slows down, well, what it tells us is the economy is headed in the wrong direction. And as we turn to companies like Target and we look at what's going on in the retail space, well, what we find out is things are getting far worse than many expected. As U.S. retail sales broadly advance, capping a solid holiday season. Well, that's what the headline says, but the actual numbers don't look that good at all. The value of retail purchases not adjusted for inflation, there's a keyword, not adjusted, increased 0.4% after an upward revised 0.8% gain in November. Excluding autos and gasoline, sales climbed 0.3%, suggesting Americans came out and spent in a big way. But that's not the complete picture here, because when we adjust it for inflation, we get a bit of a different look. And on this chart here, we have real retail sales, that's inflation adjusted. What we can see is the year-over-year rate of change was just over 1%, somewhere right around 1.27%. Hardly a booming holiday season. In fact, it barely made the positive line there. And over the past 3 years, what have we seen with real retail sales? Well, they've been negative. So this was just a holiday bump. Many people now saying has everything to do with households front running the tariffs and wanting to get in before prices go up. If that is correct, what we should see at the beginning of this year is a big drop in demand, particularly as households turn to their debt and look at their credit card bills and the high interest they're paying and start focusing on debt pay down. If they do that, there's going to be a huge sacrifice in the retail space. We'll see what Target's warning about, because it's all going to come back. We started the show talking about labor. There's a good reason, because what's coming is not good for U.S. workers. And Thursday's figures point to a consumer that held up well in the holiday season, supported by wages rising faster than prices. And I told you this would come out. I told you that the media would focus on the fact that wages are indeed higher than prices, so everything's going to be okay. Consumers can afford higher prices. They're going to come out and spend. And I told you it doesn't matter. I'm going to show you a chart here in a moment, but let's continue on, because while underlying inflation eased last month, Americans are still contending with a high cost of living, and some retailers are considered raising prices in anticipation of higher tariffs on imported goods after Trump takes office next week. So what we're seeing here is businesses now talking about front-running the tariffs, because they know once the tariffs hit, those costs are going to get passed right along to consumers, and they have inventory right now they want to move. They desperately need to move it because the holiday season was nowhere as near as good as they hoped. So what they're looking to do is to boost their margins, to keep their stock price elevated, and that means front-run the tariffs, raise the prices now, but the problem is it's a little too late. But let's take a look at this chart here, because what it tells us is the U.S. consumer is tapped out and that wage growth doesn't really matter here. As we look at the consumer price index in blue against average hourly earnings of production and non-supervisory employees, that in red, both on a year-over-year rate of change. And we can look at the chart right here, and you can see the red line above the blue, which is what I said the media and the political elites we're going to focus on, is that the U.S. consumer is in great shape, that their wages are higher than inflation. This is not a problem. They can afford these higher prices. And in fact, rather than worry about a recession, we should worry about a resurgence in inflation. But if we go back in time, let's take a look At going into the global financial crisis, what do we see? Wages were higher than inflation, and we still had a recession. How about the dot-com bubble? Wages were higher than inflation all the way through, but we still had a recession, telling us that the fact that earnings are higher than inflation doesn't matter at all. But a big indicator that consumers are tapped out is spending at restaurants and bars. The only service sector category in the retail report has declined by 0.3%, the biggest drop since the start of last year. Now, why does this matter? Because the first thing households do when they tighten their budget is they stop eating out, because it's so much cheaper to eat at home than it is to eat in a restaurant. It's the easiest change to make. So when we see a drop there, it's telling us consumers are worried about the economy, and in a big way, because they know what's coming, and that is what we're seeing in the initial claims and the continued claims data on a non-seasonally adjusted basis. As we take a look at real retail sales, still in blue against continued unemployment claims in red. And as real retail sales decline, as we go back here to 1999 into the early 2000s, what happens? Continued claims start to rise and they continue to increase. We see that again around 2006 as real retail sales slow and continued claims head higher, and we're seeing that now. We just don't see it on a seasonally adjusted basis, but we're clearly seeing it on a non-seasonally adjusted basis. And the risk here is the economy is in no place to absorb these workers as they hit the unemployment line. It means their spending is going to drop. And now we turn to Target, who issued a major warning for the economy as Target lifts its outlook on holiday sales and gain for apparel and toys. But despite the fact that at a record Black Friday and Cyber Monday, it wasn't that great. And Target has been struggling to reignite sales for more than a year as consumers spend less on non-essential items such as home goods, which has been historically one of the company's strongest categories. So what does that tell you? Consumers have less money. We see that very clearly as they eat out less, and then they spend less money on discretionary goods and services. And despite the fact that the government says that wage growth is higher than inflation, what did we see in the report yesterday when we talked about labor statistics? It said the year-over-year rate of change in terms of wage growth dropped to 1%. And if that's correct, it means that incomes are not growing faster than inflation, and the spending is going to drop even more. And now let's take a look at what Target had to say, because their latest results suggest that Target is making progress. Well, maybe not that great of progress. A nearly 3% increase in online and in-store traffic helped spark record sales during Black Friday and Cyber Monday. Comparable sales rose 2% in November and December. But keep in mind, inflation is running at 2.9%. So it's not as great as it looks. What it suggests is Target marginally got ahead here. And this is why we're seeing the potential next Treasury Secretary. He's saying we need tax cuts in a big way, because he's saying it's the most important economic issue. And why is that? Because the labor market's coming unwound. We know the relationship between sales and labor. When sales decline, companies lay people off. And what Target's saying here is we're not getting the discretionary spend we're used to. We're seeing it in the restaurant space all across the country. Restaurant after restaurant is closing its doors. And if they're not closing and saying we're moving locations, we're closing it because demand is weak. We're consolidating to the restaurants we do have, our higher performing restaurants. And we see that in retailers around the country. They're starting to say, we're going to close our unprofitable stores and only keep the ones we need. And this is not good for U.S. workers, because it's very clear there's no opportunity. Continued claims are rising. We're seeing manufacturing slow down. The services sector is starting to follow suit. There are no jobs. And that's why you're going to see a big push for more tax cuts, because it's one reason and one reason only: puts money in people's pockets. But remember, the expert said the Fed wouldn't raise rates till the middle of the year. Well, Fed's Waller came out today and says fresh rate cuts possible in the first half of 2025. Why is that? He said, if we continue getting numbers like this, referring to the consumer price index, it's reasonable to think rate cuts could happen in the first half of the year, and that he wouldn't entirely rule out a cut in March. Why is that? It's not because inflation's coming down, my friends. It's because the labor market is starting to unwind. The government's covering it up with the seasonally adjusted numbers. The non-seasonally adjusted are clearly saying there's a rise in initial and continued claims. This is a dangerous path, because if they do not reverse direction in the coming weeks, what it suggests is the Fed's got this completely wrong. It's going to be too late for the government to react to save the economy. It means we're squarely headed into recession. And Target's warning has been very clear. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.